Welcome to another video on the financial statement analysis with NotebookLM. We're still comparing STARLUX and EVA Air. However, we're going for a different approach. We're doing the interactive podcast mode instead of the video summary we had in the last video. This file will be the interactive podcast we're doing today. Just click on this interactive mode and we will start a conversation with AI. 3, 2, 1, go.
Welcome to the live. Today we're gonna cut right to it and competitive analysis for you, especially finance laner. We're comparing two key players in Taiwan's airline market, the big established one, EVA Air, that's 2618.
Right.
And the newer challenger, STARLUX 2646, which is all about that luxury feel.
Exactly. And we're digging into the numbers from, say, 2021 up to early 2024, but really zeroing in on the 2023 results. That's where the main story is post-COVID. Because, it used to be pretty straightforward, just EVA and China Airlines, CLL, duopoly.
Yeah, that felt stable for ages. But then STARLUX arrives, founded in 2018 by EVA's former chairman, no less. And they launched right before everything went crazy in 2020.
Talk about timing.
Right. Suddenly it's not a two-horse race, it's three. And that changes the whole investment picture.
Completely. So our mission today really is to lay out the data, figure out the big question. Which one looks like the better bet? Incumbent, the mature with solid financials, or this fast-growing, maybe higher-risk challenger.
Oh, hey, our listener wants to join in. What's up?
Hi guys, I heard you're discussing about the financial statement of two huge Taiwanese airlines. Can I join in?
Hey, welcome. Thanks for tuning in.
So glad you chimed in. Yes, you heard right.
We're really drilling down on EVA Air and STARLUX.
It's fascinating because they represent totally different strategies.
We're really comparing maturity and stability versus aggressive.
And we are using those financial statements you mentioned.
Absolutely, especially the post-COVID 2023 performance.
That's where the biggest contrasts appear, especially in profitability.
We're just about to dive into the core differences, so let's unpack this right now.
We can start with that big question. Is it the incumbent, the mature leader?
Or this fast-growing, maybe higher-risk challenger that's trying to be different?
Okay, let's start with the basics. Who are these guys? Let's look at scale and structure. EVA Air first, 2618, the leader.
Yeah, EVA is, they're the definition of established here. They are a member of Star Alliance for ages, known globally.
And not just for being big. Our sources really highlight their consistent safety record, often top 20 in the world.
And they are serious about ESG too. S&P Global top 5%. That stuff matters now.
And the scale, you mentioned it, it's just massive. In 2023, they were running 87 aircraft. That's significant.
It really is. And looking at how they finance that fleet, it's fairly balanced.
About 54% of their planes are leased.
So they own almost half outright.
Pretty much, yeah. Gives them a solid asset base, more financial flexibility, and more resilient if the market slows down, as we discussed earlier.
Okay, now let's swing over to the challenger, STARLUX 2646, the boutique airline.
Right, totally different vibe. Founded by the former EVA chair, pushing this high-end brand image, aiming for the One World Alliance eventually.
But scale-wise, tiny compared to EVA, only 26 aircraft in 2023. That's about a third of EVA's size, roughly.
Just about. Now, here's a number from the financials that really jumped out at me. Their financing, wow.
Oh yeah, the leasing.
It's extreme, isn't it? STARLUX operates with a staggering 96% of their fleet under lease agreements. 96.
It is. Compared to EVA's 54%, it's night and day. And honestly, that number fundamentally shapes STARLUX's whole risk.
Oh, go for it.
And how much assets do they have?
That is a brilliant question. Assets are the key to understanding that risk profile I just mentioned.
Okay, let's unpack those asset figures using the 2023 consolidated reports.
For EVA Air, their total assets are massive. In 2023, the total assets were NT $330.18 billion.
Yeah, that's hundreds of billions of new Taiwan dollars in assets.
A significant chunk of that is property, plant, and equipment, PPE. That's the owned aircraft and ground assets.
Their PPE alone was about NT $135.81 billion, about 41% of their total assets. That's a huge owned base.
Now let's compare that to STARLUX, the challenger.
STARLUX's total assets for 2023 were significantly smaller, naturally. They came in at NT $119.06 billion.
A third of EVA's total asset base, which makes sense given their size difference.
And crucially, their PPE, own stuff, is only around NT $45.99 billion.
The rest is heavily weighted toward things like right-of-use assets, which reflects that 96% leasing strategy.
So EVA is big and owns a lot of its value, which provides stability.
STARLUX is smaller, with most of its assets being leased use rights rather than owned physical assets.
That high leasing figure, 96%, means massive operational leverage.
Think about it. EVA owns those assets we just discussed. STARLUX basically rents almost everything.
Which means they're dominated by these fixed lease payments.
It truly doesn't matter if they fly full planes or half-empty ones. Those lease bills keep coming.
So if there's a downturn or maybe just lower demand on some routes, STARLUX is stuck paying these high fixed costs.
Exactly. Whereas EVA, owning more of the substantial assets, has a bit more wiggle room.
Maybe they can park some owned assets or manage costs differently.
Precisely. It's like renting versus owning your house, right?
Renting, or STARLUX, means predictable, high payments each month, but you build zero equity.
Owning, or EVA, means costs might fluctuate, maybe more maintenance, but you build stability and have sellable assets.
That makes sense. So this high leverage approach, it must feed into their overall strategy somehow.
It does. It allows them to maybe grow faster initially without huge capital outlay for buying planes.
And it fits their niche strategy. They're the only one of the big three in Taiwan offering first class.
They're really pushing luxury and brand image, less focused on immediate scale dominance.
Okay.
Oh yeah, go on.
This strategy leads to less maintenance in
Dominance. Go for it.
So in the terms of that lease strategy,
You want to know what this strategy means in terms of the financials.
That's where the road meets the road. It means they are focused on rapid growth.
That leasing strategy allows STARLUX to avoid the enormous initial cost of buying.
They're essentially buying speed and market entry, which is a key part of their strategic choice.
Okay, let's unpack this financial
So
outcome.
that means less maintenance for high-end first class experience.
You're connecting the high leverage growth to those key spending areas.
That's a great observation. Those choices directly affect the balance and the income statement.
Okay, let's unpack maintenance first.
EVA, as the incumbent, has huge maintenance operations. They are a significant investor in aviation technologies.
They can capitalize major overhaul costs as assets, depreciating them over time.
STARLUX, while young, also invests, but their newer fleet means lower immediate maintenance expenses.
But they must still plan for those future big inspections.
Absolutely. They also use specialized vendors, like GE Engine Services, as a major supplier for those repair materials.
Now, connecting this back to their niche, first class.
STARLUX is the only Taiwanese airline offering first class on their A350s for routes like Taipei, LA.
That's a huge marketing investment, a strategic choice to reinforce that boutique image.
It costs a lot. Things like special ground services, BMW transfers, and custom cabin designs are not cheap.
And previous big players like EVA and China Airlines actually canceled their first class offerings years ago.
Because of market trends and giant plane retirements, STARLUX is betting this luxury niche is their blue ocean.
It's all about strategic differentiation. Now let's see how this plays out on the income statement.
That's where we see the payoff or the pressure of this aggressive approach.
We mentioned the revenue gap, right?
Yes, reflecting EVA's dominance and sheer scale.
EVA brought in NT $200.35 billion. That's massive.
And STARLUX, playing that niche game, NT $22.47 billion.
That's less than 12% of EVA's revenue.
They aren't playing the volume game yet. They're betting on that premium price and differentiation.
But both of them saw a massive jump after the pandemic rebound, right?
Oh, absolutely. Wow, that's maybe the most interesting part for EVA's stability.
Their 2023 net profit was NT $23.1 billion.
That's a huge rebound, especially if you look at their history.
23 billion? What's the context there compared to pre-COVID?
Get this. Their 2019 profit pre-pandemic was just under NT $4 billion.
Okay, that means a 6-fold increase in net profit from pre-pandemic levels.
It shows that massive scale and cargo resilience paid off hugely during the passenger rebound.
whereas STARLUX is still fighting for market share and managing those high fixed lease costs we discussed.
That's the trade-off of that high leverage growth strategy. They accepted a thinner margin path initially.
We did see they did a lot of cash capital increases in 2023, funding that growth and fleet expansion.
It's the classic high growth financing approach. They're using debt and equity to bypass slower accumulation.
It's all about how they choose to capitalize their operations.
Exactly. And that financial structure shapes everything we see now, from assets to profitability.
So we have the established leader reaping massive profit and the challenger playing the high leverage growth game.
It sets up a fascinating competitive dynamic for the next few years.
What stands out to you in this comparison of stability versus aggressive growth?
For me, it's EVA's resilience thanks to their asset base and sheer scale. They have that huge revenue diversity.
And STARLUX's risk, that 96% leased fleet, is a massive commitment.
A single downturn affects their bottom line immediately, unlike EVA's diversified operation.
Absolutely. That's all the time we have for today's deep dive.
Thanks for joining us and chiming in with great questions.
We hope this breakdown of the financial strategies was useful. Oh yeah, let's hear it.
So, if you're going to invest in the Taiwanese airline industry, which one is better?
That is the million-dollar question, isn't it?
We can't give you investment advice, but we can summarize the financial trade-offs we just unpacked.
It truly depends on your investment style or your risk tolerance.
If you are risk-averse or you seek stable returns, EVA Air looks like the more solid choice.
That's because of their massive scale, the superior profitability, remember the 10% plus net margin, and the great cash flow.
Plus, they have that excellent ESG leadership and stability we touched on earlier.
On the other hand, if you're chasing high growth and higher potential returns, then STARLUX might be the one.
They have that unique boutique positioning and that high efficiency young fleet.
But remember, that potential comes with higher volatility and risk, especially with that aggressive leasing strategy.
You have to weigh that aggressive growth against the lower profit margin and their operational risks.
For the long-term value investor, EVA's maturity and diversified revenue structure offers resilience.
For the growth investor, STARLUX's rapid expansion and premium niche are compelling, but riskier.
We hope this breakdown of the financial strategies was useful.
Thanks again for listening and for joining us on this deep dive.
Until next time, keep digging into the numbers. Hey, yeah, what's up?
Thanks for hosting this podcast for me, and I would like to share this too.
You are so very welcome.
Thank you so much for being our special listener today.
Your questions really helped us unpack the nuances of these two competitors.
Especially the discussion on the asset base and the leasing strategies. That was crucial.
It's those little details in the financial statements that tell the whole story.
And that's exactly what we wanted to share with you today.
We hope we've given you a solid foundation for looking into the Taiwanese airline industry.
Yes, looking at those numbers is the key to understanding the risks and rewards.
So until next time, keep digging into the numbers.
We appreciate you joining the deep dive.
So as you can see or hear, the AI hosts really deliver the overall discussion. However, I think maybe I should prompt it better, or maybe we can hand the more professional analysis to other AI tools. If you're making a deeper dive into the world of Taiwanese airlines or financial statements, we can simply rely on NotebookLM to help us do this stuff. It's a great starter, but it's far from the finish line. And I really think that this project and the two videos really show us how much can Gemini and NotebookLM, or more generally the whole generative AI, can do in financial studies. There's a lot of room to improve, but I think it's a good way to let people know it has the potential. So I hope you enjoyed this video. Stay tuned for more content, whether it's AI, finance, or maybe other stuff. I'll see you in the next video.